informal conversation with Graham. Commissioner, are you with us?
He may be grabbing something also. There he is.
I'm here. Sorry, it took me a second.
I'm guessing that this amendment has been rewritten to protect us to the full extent possible or practical against the state revenue loss. And that was perhaps a concern you had going into this. Do you feel at this point that there's enough checks and balances here that if for some reason in your workup with joint fiscal you're feeling uncomfortable, you can delay implementation here so that we don't lose any state revenue? It seems like a real, as you say, as close as you can in free money for these taxpayers as opposed to where they are now, but we don't want to wind up jeopardizing state revenues.
Yeah, thank you, Mr. Chair. For the record, Craig Bolio, Tax Commissioner. So I do see the new draft that has the contingent effective dates and noted that there were some changes on that. I guess the only other comment I'd have is it says right now projected to have a neutral impact. But as we've talked about before, and as I think is highlighted by Graham's example on the website, there's a fair number of these taxpayers who will pay more to the state and still elect to do this because they will save more than that at the federal level. And that's been part of that's not a surprise to us at all. That's been part of the structure that we've been considering. So I suppose we would want to say that it has at least a neutral impact on the revenues of the state. It might have a positive impact on the revenues of the state, but people would still elect it because it will save them money overall. And the governor won't have an issue with that so long as the structure is elective, and therefore people are only going to elect it if it saves them money.
So, Abby, can we make that change? It sounds fairly technical. I think that was what the intent is. It's obviously not going to come down to be neutral to the exact penny. So we don't want to stop this from going forward if it's $1 over not neutral. I don't know if you think that's a necessary change or how you would work that.
For the record, Abby Shepherd, Office of Legislative Counsel, I think it could read that the consensus estimate is projected to have a neutral or positive impact on the revenues of the state. Or it could be phrased in the negative, are projected not to have a negative impact on the revenues of the state, but then you get into some gray area of if there is some negative impact, what's an acceptable amount, and how to set parameters around that. So I don't know if the perhaps the first option is a little more clear, neutral or positive impact.
So before we lose Abby, which is at 10:30, I just want to understand the options of where we go from here. Senator Brock and I know are on this amendment. They may want others, or others may want to be on the amendment. But the question I have is, part of the reason to get this in now is we probably have another 2 or 3 weeks in the legislative session. I don't know if anything is going to change in terms of comfort level with this, in terms of discussions between the 2 of you or the 3 of you. But if no discussions occur, and we don't want to change anything in terms of the conference committee, what is the next step as to what happens where joint fiscal and the tax department come together? What exactly are you looking for? Just enough information to make this threshold decision by July 15th or 25th, or is there more things ideally that you'd like to see in this bill?
Our special needs with that.
Either,
I'm sorry, was that a question to me, Mr. Chair?
yeah, I guess it was best
Okay.
first answered by you.
I think Abby raises a great question about what does not negative mean, right? Like what happens if JFO and tax work on this and it's a projected loss of $100,000 or $10,000, right? Right. What's the threshold by which the legislature would say that's too much? I mean, maybe it's $1. I don't know. Again, I would leave that up to the legislature and how you folks want to handle the budget construct. The only other question I have on this is in a different section. I think it's still pretty technical, but I'm just trying to wrap my head around the wording on the other states' credit. And it says, okay, non-refundable credit shall be 90% of the taxpayer's pro rata share of tax paid to another state, provided the amount of the credit does not exceed the amount of income tax owed under this chapter. I feel like that might be redundant with the word non-refundable. And I think what we're going for there is that the 90% credit that we are offering is not more than would be offered had they paid Vermont pass-through entity tax. And maybe I'm also misreading it, and that's already what it says. But that's really the only other comment I had.
I'll let Abby answer that because it's way above my pay grade at this point.
Yes, I believe your former understanding that you listed. So it really reiterates that it's not refundable against personal income tax. So the second clause could potentially be removed since the word non-refundable is in front of the credit. Unless there was a second limit added in there that it would not exceed the amount of the credit against the pass-through entity level tax. That would be sort of a two-pronged limit. Right now, it's only that it's non-refundable for personal income tax. And for the committee, that means that the credit cannot be taken beyond any income tax that's owed.
So, Mr. Chair, since I'm not an attorney, I never want to write language on the fly, so please forgive me. But the way that we generally handle the other states' credits is that the credit that you would get is essentially only the larger of what you actually paid in that tax, in that state, other state in tax, or what you would have paid had you paid it in Vermont. So I think what we might want to adjust that to is that the credit is 90% of the other state's pass-through entity tax to have parity with our own, that cannot exceed the amount of the credit that they would have gotten if they had paid that pass-through entity tax in Vermont. Or said another way, that the credit cannot be more than 90% of a 7.6% rate on that income, if that makes sense.
I would leave that to Abby. If she agrees with you, then we can make that change now, or we can make the change later on. But those are the kinds of things that I think could be adjusted if you're comfortable with the direction we're going, Commissioner, in conference or as we go forward, or we can make it now. It's a simple drafting change. We don't have a lot of time. Abby's due in another committee at 10:30. We do have the lunch hour to clean it up, but I'd like to take a vote of my committee on one version or another. Abby, are you okay with the suggestions being made by the commission?
Yes, absolutely. That's a quick, easy fix. I can add that in to the language. So
Make
it
those
would be
changes. I guess what I was going for, my question to you, Commissioner, what do you see, let's say we go home and this bill passes, what do you see the conversations with joint fiscal entail? Trying to get projections on the revenue neutrality and consensus opinion on that?
Yeah, from my chair, that's the next step. Do the modeling, work with the joint fiscal office, see if we can come up with what the revenue impacts would be. And then it's just the speed of which we can do that is the next most important factor, because I want to give us as much runway as possible to stand this up, because it's complicated.
Okay. I guess I really don't want to get into a gray area for how much of net loss revenue to the state may be or gain. I would just make it that the model essentially has to show either a gain or zero in there. You know, if it's $1 under, then this doesn't go forward. That's been the understanding the whole way through. And we come back and we do whatever we can to get it up and running next year. So I think the initial projection sounds to me like there wouldn't be any loss to the state. That's what I think you've been shooting for with the 90%. Maybe I'm not understanding it, but I don't think the intent of this committee in terms of trying to rush this through was to lose any tax revenue to the state.
No.
So I don't have any concern with that, Mr. Chair, that it's got to be either zero or positive. The only thing I would say, and this is not a reason to move forward or not, is I don't know how it'll shake out. It's really complicated and it's going to take some work to do that. So I can't promise that it will have that 22 effective date with that provision, but I don't. It's a simple way to do it, and I don't have any concerns with that. I prefer that to, as you said, a gray area. So
yeah, even if we said 1% less than zero, that's a fixed number. Becomes the fixed number. So okay. So Abby, if you can draft it up that way. And we could continue to talk with Graham a little bit about it, his example. But, thank you.
Which is what we have. And remind us how many, Craig and Abby and Graham, how many other states have now moved and taken advantage of this and figured it out that this is an opportunity?
I think it's 24 as of a couple of days ago. I think Virginia signed a law. Hey, the only other thing I want to mention while I have a second, I said yesterday in committee that we thought it might be the cap might be costing Vermonters $250 million in federal taxes. We've worked with Graham a little bit overnight, and I think that number is probably high. We found some areas where we didn't control for it. So Graham had come up with a number closer to 50, which is still a lot, but I think it's probably closer to that than the 250 I cited yesterday. So apologies for that.
If something had cost taxpayers $250 million, I think we would have heard a lot about it.
Yeah, well, I think we've still heard a lot about it, even at the 50 million. There's a lot of states that have not appreciated this cap.
Yeah.
And there were states that just tried to sue as well, saying it was unconstitutional, but the U.S. Supreme Court decided not to take that case. So, yeah, it's just been an interesting couple of years over this provision.
Yeah.
Okay.
Thank
you very much, Abby, and we'll look forward to getting your final version. And we'll probably just, I don't know who's going to walk us through it, but I think we're familiar enough with it. Could you come back around 12? Do you think?
Yes, that's possible. So I do have just making those two small changes. The draft is updated now. I will send that to Scott, and then I would be happy to come back and walk the committee through it. There is a section by section that Scott's already posted on the website as well. If you wanted to take a look at that beforehand. And I'd be happy to come back in about an hour and a half.
A section by section on an amendment?
On the amendment, that's right.
I think that's unusual.
No, the amendment is what we're putting on the bill, the whole thing.
Right.
She's doing just as 159. It's the whole thing.
Yes, it's just for the amendment, just to explain how each of these parts functions.
Section by section. And I don't think, and having read that and not understanding it, I think it'd be better just to tell us in general, just refresh our memory with these amendments, do without getting into the credits and all this stuff. Because I don't think people are going to really want to focus on that. Okay.
Great, thank you. I'd be happy to come back in a little over an hour and a half.
Okay, we turn to Graham. Thank you, Abby. So Graham, let's just, if you can, on the handout we have here, let's just deal with the columns on the left.
Sure.
What are the, I'm trying to find the differences here between the one in the upper left and the one in the lower left.
So for the record, Graham Campbell from the Joint Fiscal Office. the salt cap workaround example that I've posted that's on the committee's webpage. The left side is basically the federal. So the first box on is the individual level federal taxes, and then below sort of that green summary statement, there's another one for the proposed. That is the federal tax liability. So
Okay.
just to set up what this basic example is, this is a taxpayer who is a married taxpayer. They have $250,000 in adjusted gross income. And they are a business owner of a business that makes $500,000 in net income. And they are a partnership with another individual with a 50-50 split on the income. And they have no other sources of income. So they are a married taxpayer. They make $250,000. I'm in the far left column now. They have a $250,000 in adjusted gross income. All of that is pass-through income to partnership income. They are married. They have no children. A taxpayer like this would pay, based upon 2022 Vermont tax rates, or 2021 rather, about $13,400 in state income taxes. This is a proxy, but for this example, I assume this taxpayer lived in a $500,000 assessed home in Burlington, Vermont. And based upon the tax rates there for state education and municipal tax, they would pay approximately $11,000 in state property taxes between municipal and education property taxes. This couple would not be eligible for the property tax credit, so they'd be paying full freight. So their state and local taxes is $24,400, assuming they're not deducting any state sales taxes as well. As you can see, they are limited by the SALT cap, $10,000. And then I made an assumption that they gave some money to charity as well and some medical expenses. So they had $10,000 in other deductions. So in theory, this person, they could either take the standard deduction or the itemized deductions. In this example, now that I'm looking at it, they might even choose to take the standard deduction because the total deductions there are 20,000 and the standard deduction is about 24. But let's just assume for the sake that they are not acting super rationally and they are itemizing their deductions. Their federal taxable income before the pass-through deduction is $230,000. There is at the federal level a 20% deduction for pass-through income. So if you have pass-through income, you get to deduct 20% of your total income, pass-through income. And so this couple's federal taxable income after that pass-through deduction is $180,000, and their federal tax liability would be, based upon 2021 rates, would be about $31,000 in federal tax liability. Now, do you want me to touch on the state side, or do you just want to stick to the federal?
Let's just do the federal for now.
Okay, so under the proposal, because they are allowed to deduct their state and local taxes fully, the same parameters apply: $250,000 in income, $250,000 in pass-through income. Their state and local taxes are still $24,400. So, but now, because they're not limited by the cap, their state and local taxes they can deduct are $24,400. Their other deductions are $10,000. So their total deductions here would be $34,400 as opposed to $20,000 before. And so what ends up happening is their total taxable income after the pass-through deduction is $165,601, and they end up paying $27,666. So the difference between those two is, just over $3,000 in federal tax liability that they would be saving as a result of the entity tax here.
Okay. In this particular example, they wind up paying higher state taxes they wind up paying higher state taxes. So that is offset against the reduced federal taxes. That's how you get to the 1300.
That's correct. This individual would be paying approximately $1,700 more in state taxes as a result of the entity tax.
quite a bit lower in federal tax.
That's correct. They'd be paying quite a lot lower in federal income tax.
So this is just it's too late for this question right now, but maybe not for the end of the session. Why couldn't the tax form, would the IRS be against the tax form saying, as far as state taxes go, you have to continue paying as if you didn't, as if you had a cap on the SALT deduction? So just say, figure out your state taxes just the way you do now.
I'm not sure I understand the question here.
I'm happy to take that one, Mr. Chair, if helpful.
Yeah.
Yeah, so that is what some of the states have done. That's the other mechanism whereby states are requiring you to add back that difference in the distributive income from the pass-through entity tax. That's the one that I feel like is probably really tough to administer. So what we have in the latest draft from Abby is that credit scale down instead. And that's supposed to mimic a similar effect, which is recognizing that the pass-through entity is now going to be distributing less income that will impact the state as well, but you don't get that dollar for dollar credit for the taxes that you paid. That's why it's really complicated and hard to have this be a true break even for every individual taxpayer, right? So the cleaner way to do it is have it be pretty good for most taxpayers and then make it elective so that no taxpayer that would get hurt by that imperfection will take the election.
Okay.
And I just want to point out my example here. So that is, I think, depending on how this is structured, that might change the example. So in the federal example under the proposal right now, the state income taxes are as calculated under their individual state, their individual personal income tax before the entity tax credit comes into play. However, if the state income taxes is defined as, you know, what happens after the entity tax, their total state income taxes would be about $16,000, or about $15,300 rather than $13,396. And so actually their federal tax benefit would be higher because they're able to deduct more state and local income tax because they're paying more at the state level. So if it's the case that the state income taxes that would be deducted under the federal return would be something like $15,300, and the federal tax savings are actually about $3,600 instead of just $3,000 as is in this example.
And that would happen if we change this proposal, or?
I'm not.
Yeah. Why would
So I'll have to confirm with Craig and Abby how it works at the federal level, whether state income taxes federally means, you know, like whether it would mean essentially the entity level tax plus the personal income tax, or whether it means just your personal income tax. Under this example, it assumes it is really just the personal income tax before the entity tax comes into play, because I don't know whether the federal government considers taxes paid at the entity level and a back-end credit as part of the definition of state and income taxes deductible federally, if that makes sense.
I mean, I could sort of step over here on like zero taxes on an entity versus, I guess, 38,000 divided by 2, so per person, a $90,000 entity tax per person. I didn't know that current law would say that.
Well,
is net income after tax, and then below it's not after tax.
I think in lay terms, because I think that's what we need to deal with,
Yeah.
is that this entity tax is sort of a new tax that allows for you to take more SALT deduction, but you get additional benefit from an unlimited SALT deduction that's greater than the entity tax. It's a fiction that's put in there to make sure that the state pretty much evens out.
Mm-hmm.
It's a new kind of tax. Right now, you don't pay the tax you don't pay an entity tax. You pass all the income right through. to the-
Okay, so this is, I mean, at some point, this is gonna be for people who can compare which is better for them.
Yes,
Okay,
And they can make the choice.
yeah, and we just
so
don't
we
want
just don't know
to.
where the break even point is, where it's better for them.
Craig, as Commissioner, could you just tell us your phrase? One of the reasons it's sort of free money is because the feds are now paying a portion or foregoing a portion of your income tax. Is that right?
Yeah, that's why states love the SALT deduction, right? Because of the feds are going to subsidize a portion of every dollar of state tax paid.
Right.
States have loved this workaround because you can basically give a portion of your constituents a tax cut without taking money out of the state coffers.
That's what it really comes down to. And
Graham asked an excellent question. I don't know the answer to that, like how the actual SALT deduction on the personal income tax level is structured. Once you get that credit, that's a great question and indicative of how complicated this whole system is.
I think this is a very, very basic example. And so I would caution the committee on making firm conclusions about state revenue impacts or overall tax impacts. I think the only thing that I could say definitively at this point in time is that an entity tax for an individual who is able to access and use the entity tax will save, if they elect to do it, will save them on their federal taxes. That's the whole reason why this would exist. So every example that I create is going to show basically that a federal tax, they're going to save on their federal taxes. What I can't guarantee is whether they will end up paying more on the state side. And what I can also say is that generally, the higher the income the person has, the greater the savings at the federal level, because the amount of savings that you have federally is a direct function of your state and local property tax, state and local income and state and local property taxes. So in Vermont, with a very progressive income tax, very high income people will have very high state income taxes, and generally those individuals tend to have more expensive homes as well, and so they have higher property taxes. And so that's the other sort of definitive conclusion I can make, is that the higher the income, the greater the federal taxes. But I can't necessarily say whether income and state taxes are aligned here, because it really depends upon whether how much of their income is based upon pass-through income and how much overall income they have. Right now, the draft has language about 7.6% is the entity level tax. So all else equal in this example, a person would end up losing or paying more in state taxes up until the point that their personal income tax effective rate is greater than 7.6%. And that level is pretty high in Vermont. It'd be very high income, over $1 million for sure.
Let me ask you this question, Graham and Commissioner. You're saying that some people everybody's going to wind up paying less in federal taxes, but some people could wind up paying more in state taxes, and some people could wind up paying more in state taxes. That differential can be even higher than the federal thing, but they wouldn't elect in that situation, right?
That's correct. Yeah.
Everybody has an accountant in these groups, and the accountant's going to run it both ways and say, don't do it. So there probably wouldn't be an individual taxpayer in the state of Vermont that could be hurt by this proposal.
That's correct. Yeah, I would agree with that statement. They wouldn't do it if their overall tax liability, federal and state, went up, obviously, unless they're behaving irrationally. But I think I'm raising the point about the state side, because there has been talk in the committee, and it's in the bill, about the effect on state overall revenues, right? And so depending upon the makeup and income of our pass-through returns, right, it is possible that this ends up generating revenue for the state, but it could also reduce revenue. So it's really hard to say. The only information I can bring to bear at this point in time is based upon an issue brief that I did a couple of years ago on pass-through returns in Vermont. And what I'm seeing federally is that pass-through returns, individuals with pass-through returns tend to have very high income in Vermont. And so to the extent that this example is somewhat illustrative, then that sort of gives my prior that it might actually increase revenues for the state a little bit, but I don't want to make any sort of definitive statements yet because I think the Department of Taxes has the actual data and information to model this out and get a sense. So I'm just flagging that sort of concern for the committee that, you know, that Senator Sorokin is correct that everyone who elects this will save money on their overall state and federal taxes. It's just for the concern about the state revenues, it's somewhat ambiguous at this point.
So does a pass-through entity, an LLC or a partnership, can they report do they have to report their income as pass-through, or is that an election too?
I'm not exactly sure on the rules, but I think there's a rule around they have to report some of their income as wages, and then the rest is reported as pass-through income. So I'm not 100% sure what the rule is, but what exactly they have to report as wages, but I can look into that for the committee.
I'm just concerned, not for this bill, but when you made the statement that most of the pass-through entities are pretty wealthy individuals. If I'm running a dry cleaning store and I'm making $100,000 and I'm an LLC or a partnership, there's a tax advantage now for running the income through as pass-through 20%. You say, so why wouldn't I elect to have pass-through income even at $100,000 income?
You could, yes, that's correct. But I think you're raising the sort of mechanics of the tax code. The reality of the situation is that most small businesses like drive-throughs or dry cleaning businesses do not report very much taxable income at all. They oftentimes will have way less than $100,000 in taxable income. And so, and I can send this to the committee, I can send the issue brief, but pass-through businesses, the vast majority of net income reported for pass-through purposes is from the top 5% of pass-through returns. The vast majority of pass-throughs, I think based on the research that I did, is that at least a third of returns with pass-through income reported zero or negative pass-through income on their return. So, and that sort of jives with what we know about corporate income taxpayers, that the vast majority of small businesses do not report taxable income. And so in the grand scheme of business income, it's really the big fish that are reporting taxable income. And so those are likely the businesses that will be paying the entity tax if they elect to do it, are those businesses that have positive net income. And those ones tend to be bigger businesses with bigger net income, and therefore the returns that are associated with them tend to be higher income.
So,
I just need this spelled out, I think, further. So what you're saying is, I'm trying to understand the range of scenarios in which someone benefits from this. Is it that they would have a low entity tax but a high adjusted gross income? Like, do businesses that do better benefit if the person has a higher adjusted gross income? Like, who are the income, where do people benefit from this? What income range? Or is it relevant that like what their business makes as well?
I think it's the latter part. So I guess I'd sort of backtrack to say what I know for sure is that individual. So you have the business, right? And the business makes income, and that's what's getting taxed at the entity level. But then the shareholders of that business all have their associated shares of the income that is created, and that income is passed through their individual tax return. What I can say definitively is so everyone who elects to do this entity level tax is almost certain to benefit on their overall, because the individual wouldn't elect, or the entity would not elect to do it if the shareholders, if the group of them found out that they were going to end up paying more in state and federal taxes. And so I think it's a pretty safe statement to say that anyone who elects to do the entity level tax will end up benefiting to some degree. Well, the other thing I would say is that higher incomes, AGI, generally is associated and directly correlated with higher state income taxes and higher property taxes. And so that the sort of not secret sauce, but the whole reason why you create an entity tax is that you'll be able to deduct more of that. And so generally the benefit of being able to deduct more state and local taxes is more beneficial for higher income people. So that's the other thing I would say. In terms of whether they end up paying more in state taxes, it is really dependent upon A, what their overall income is, B, how much money does their business make, and B, what is their split on the partnership there, how much of the share of that income do they have? So if you have a business that's making $50 million and you have a 2-partner business, your income is going to be higher. Effective rate on your personal income tax is going to be higher, and therefore the sort of the entity level tax, the 7.6, is closer to your actual state tax rate, effective tax rate of about 7-ish%. But if your income is lower, then the difference between paying the entity level tax and your paying the tax on your personal income tax, the effective rates are much more farther apart. And so that's why you end up paying more under the entity tax than your state income tax. And that's why you end up paying more state taxes in general. And so I think overall what I'd say is that dynamic between how much you pay in state overall taxes is really dependent on A, your income, B, how much business income your business has, and C, how much of the share of the business income is yours. So that's what's getting passed through to your income tax return.
So every case is going to be individually figured out. I mean, there's no flat benefit that everyone's going to see.
That's correct.
Yep. Consider it individually before they can appreciate how this might benefit them.
Does it help someone more if they have more business entities to sort of shed liability in any way?
Federally, I don't think it matters for their federal taxes.
It's all amalgamated. It's all one.
Yeah, I just don't. I don't know about the number of businesses they have their hands in, whether that makes a difference for the state side or not. It really depends upon whether all of those are electing to do the entity level tax and what their share of that income is. Because it's very possible that someone has a share of a business that's 5% or it's up to 85%. It's not, evenly split all the time. Pass through income generally is a complicated beast that,
Yes.
Understanding how it all flows through, and people with pass through income it's for a lot of cases, it's very cut and dry. You are a business owner. You may have a partner. You operate fully in Vermont. You have a dry cleaning outlet or two. That's a pretty standard pass through. But a lot of people, particularly high income individuals, will have shares of businesses all over the place, and they'll have small shares in some and large shares in others. It can be pretty complicated.
Okay.
That's
Thank
why
you
we're
both.
glad.
Thank you both. Stay tuned. I'm going to present this on the floor today, and we'll see where it goes from there.
But we need to vote it. Oh, we're getting Abby's amendment. We're going to vote it out. Do you want Becca here by noon if she's available?
If you want to ask her whether she wants to vote or not, it's fine. It's a section.
So I just want to make sure I understand, we're not going to have, there's no possible way to have like a fiscal impact assessment.
Well,
before.
the best we could do, Graham is shaking his head. He said that it would save just $50 million. Craig Bolio said yesterday $250 million. I've seen charts that say reduction in state and local taxes is about $1 billion. And using the 25% tax rate, that would be 250,000. But Graham correctly points out, not everybody who sees a reduction in state and local taxes will necessarily take advantage of this. So, comfortable as broad as it is 50 to 250. The fiscal note on state revenue, which you really want to know, is I think unnecessary because there's a bar here from losing any money. What will it
Okay.
affect if we lose any money? And that's going to depend on sophisticated modeling that they're going to have to project forward as to what the impact of state revenue is.
Right.
I assume we're going to say on floors, you can't lose.
I'll leave that to you to follow up on it when I get a question.
But that's effectively what we are saying, realistically, is
It's
that
close-
it's
this
close
should
to
be
free money.
structured in such a way that we are comfortable, based on all the information we have, that this is not just revenue neutral, but it could be revenue positive. Again, without imposing a tax.
Right.
Without imposing a new tax, which is the drop dead piece as far as the administration is concerned. It's not a new tax.
Just to clarify, the committee asked yesterday about what was my estimate for the effect of the state and local tax cap, and my rough calculation is that it's absent no other provision from the Tax Cuts and Jobs Act, the limit on state and local taxes is leading to somewhere between $40 and $50 million more in federal state income tax for people who are impacted by the cap. That is not necessarily the amount of taxes that people will save, because whoever elects this, I don't know what share of that is held by pass-through owners. And so
It's a number that was mentioned, and I don't know, Graham, whether it was by you a couple of days ago, that started at a $12 million savings. Does that ring a bell?
I mentioned that.
Okay, that was you.
I mentioned that, and I saw it in an article that was sent to me where they broke down states, but I'm not 100% sure I was reading it correctly.
But I like Graham's number better.
The 50 million or the 250? The 250.
50's good.
the $50 million is the number that it's all Vermonters, but not all Vermonters have pass-through income. In fact, the vast majority of them do not. And so
And
that's
not all
the,
we're going to choose to do it.
Correct.
and then so you have to narrow that. So take out the non-pass-through owners, and then whatever's left over, then you have to sort of make a guess at how many of those pass-through owners will actually elect to do this. And so
That might get you closer to 12 million.
perhaps, yeah. I don't know. I don't know. I don't have a breakdown for the share of state and local property taxes paid by pass-through business owners.
So could someone help me understand that if we say there's no way for it to negatively impact our state tax revenue, is that on a per individual basis, or we just don't believe it will negatively impact? So we're just saying their state income tax can't go down.
The provision in the bill says the commissioner can't certify this if there's a negative impact in the aggregate. In the individual case, nobody will sign up for this if they're going to lose.
Right, that's
If they're
the
going to
issue.
lose for net between state and federal, they just won't sign up.
The election to do it belongs to the individual.
Uh-huh.
And so we are making the assumption that no one deliberately want to pay more taxes than they have to.
Okay.
But again,
Because the only place there's no way they're going to see a reduction in their
Overall tax.
Overall tax.
Between the two. If they did, they wouldn't sign up for it.
okay.
They just stay the status quo.
Okay.
So, but there can be some people who would make more in savings on the federal, and they have to pay extra on the state level, and they were elected. And then, but the conglomeration of all of those people who were elected
Yeah.
has to be revenue neutral or make a profit for the state.
Okay.
We can't lose revenue, otherwise the commissioner won't certify this.
Right, that's the additional language that Abby's, that's what Abby's working on right now. So I think it's a a win-win.
That's the whole idea. That's why we followed up on it.
Right.
Yeah.
That's why all the states are jumping on board too.
I'd like to know what states, Graham, do you have any sense of these 24 states that have enacted this? Whether it's how much is being saved?
I spent some time last week looking at states that have enacted this, and they did not. I have not been able to find a fiscal note that has laid out any sort of estimates for what this is either costing or gaining revenue for them. So no, the answer is no. I don't know.
Yeah. But and when did they begin? When did this? When did the march of the 24 states begin? How many years has this been being, since 2017, since what, for the last 3 or 4
The
years?
majority of the states, I looked it up last night. I think it was like between 2017 and 2020, there were a handful of states. But then the IRS gave its blessing to doing this.
Ah,
The
and then,
floodgates opened.
then more, the floodgates
When
opened,
did
right,
they do that?
In 2020.
in 2020.
It was, I believe, November of 2020, Senator. They issued
Right, you said.
notice 2020-75, I believe, blessed this approach, and then it's been floodgates since then.
Right, open those floodgates.
And keep in mind also, another thing that makes the numbers seem even higher to me, what is there, about 6 or 7 or 8 states that don't have any income tax at all?
Oh, okay. So,
Right.
that doesn't apply.
So it doesn't
Got it.
apply,
Yeah.
like our neighbor to the east.
As of
Although they have
December,
corporate tax, I mean, they have, this. They don't, they have personal tax, they have corporate tax,
It's only the sole and the tax.
and this is only applying.
as of December of last year, I'm looking at an article right now that says, I think it's 19 states, and there were several pending at that point, and I know there's been more since then.
Right. Okay,
The states that surround us, with the exception of New Hampshire, that has no tax.
Right.
Have all enacted it.
oh, we're the last,
I believe Massachusetts has, and Graham, you know, they were pending as of December, but New York has, Rhode Island has, Connecticut has, New Jersey, Maryland,
Maine.
Maine had not as of that point.
Is there anything you're seeing about why they wouldn't, like,
They're probably just like us, they haven't gotten around to it.
see the opportunity? Okay.
I haven't seen any reason why not.
Generally, sorry, I don't mean to I've been generally the in the articles that I've read about why you might not do this are basically threefold. First is you're giving a federal tax benefit at the state level to people who only have pass-through income. So there's an equity concern about wages, people who earn wages, which is the vast majority of individuals, and they don't get the opportunity to impact. The second is complexity. It introduces complexity into the state tax code, and a level of complexity that only people who have the ability to hire accountants to make this calculation have the ability to do so. And I was going to do a third one, but I can't remember the third. The third is, just a general thinking about, because the impacts of the benefits to this are generally to high income and very high income taxpayers, whether the state should be doing something to give these people a federal tax break.
Right.
Those are the three that I've read in articles looking at this that are highlighted.
However, given the amount they're benefiting, my guess is states that don't have personal income tax aren't about to do it to get to benefit this amount, which is modest. So, that's why
Right, and I mean, I guess the counter to that is when the federal bucket is leaky, are your people benefiting or are somebody else's people benefiting? Unfortunately, they have created a hole in their bucket and the water's spilling to other states and not to ours.
there's a hole.
Okay, do we have any workforce witnesses?
I think we may, because Amanda's here, that means somebody Amanda is working with may be expected on.
Chris is here from UVM.
he's on Zoom, and Matt will be here.
Any minute.
Chris is here. Thank you, and I'm gonna,
Thank you, Commissioner. Thank you, Graham.
thank you guys,
Thanks for sticking with this, okay?
that, for your patience with us. Well, actually, we're all kind of getting it slowly but surely. Maybe we take a minute break
Yeah.
because the women's flu last break was news to me.
So